In this video, we're going to take a look at why the uranium shortage that already exists is still not visible to investors. The idea is simple. There's a real supply deficit today, but it's being hidden by the way the physical fuel cycle works. I'll walk through 4 points that make the picture clearer and explain where investors will see the first signs of change. Point 1 is this. The market is already in a supply deficit, but you can't see it on the surface. Official supply-demand charts look balanced, but the balance depends on mines producing at full nameplate capacity, something that almost never happens. Across decades, uranium mines have delivered only 70 to 84% of what their nameplate says they should. Once you adjust for that, supply has been trailing true requirements for years. That gap has been filled quietly by past inventories, which is why nothing looks urgent yet. For investors, the idea here is that the deficit isn't theoretical or in the future. It's real today. It's simply being absorbed out of sight. The timing of the next uranium cycle is critical for investors. To understand more about when it will turn, you need our white paper Behind the Curve. Download it below in the description section. Point 2 is this. The inventory numbers people quote are not the inventories the market can actually use. When you hear that the world holds hundreds of thousands of tons of uranium, it sounds like there's a huge buffer. But most of that material is not available to meet market demand. The big chunk is strategic stock, held by governments for energy security. Those pounds do not trade. Another portion sits mid-fuel cycle, material already converted or enriched. Once uranium enters that pipeline, it can't be pulled back out. Utilities also hold operating inventory to ensure future reload coverage. Those pounds are spoken for. And trader-held inventory often looks like spare pounds, but much of it is already committed through carry trades and forward contracts. When you strip all of this away, the truly mobile portion, material that can actually flow into the market, is much smaller, possibly only 10 to 20,000 tons outside China and India. That's roughly a year's worth of coverage at current deficit rates. And here's the simple takeaway. The market appears well supplied until you focus on the material that can really move. That pool is small. And once it thins, conditions change quickly. Point 3 is this. The remaining inventory buffer gives the market only a short runway. At today's structural deficit, the usable pool may cover 1, maybe 2 years of demand. That's not much time when you look at the supply timeline. New mines take 7 to 10 years to develop. Restarts, even when approved, typically need 2 to 3 years. And secondary sources like underfeeding shrink when enrichment is tight. In other words, nothing on the supply side can accelerate fast enough to replace that buffer once it's drawn down. For investors, the key point is that timing in this market revolves around how quickly the remaining runway is used up, not when new mines come online. The 4th point is this. When inventories hit minimum levels, the market shifts from calm to competitive very quickly. Utilities can no longer rely on stockpiles, so they move back into the long-term contracting market. That tightens contract terms before spot prices react. Only later do we see spot move, as discretionary pounds disappear and traders can't source material easily. The shift can feel sudden, but it isn't. The underlying tightness was there all along. It was just hidden behind inventory. And for investors, this is the moment when the story becomes visible. Contracting behavior changes first. Prices follow. By the time spot moves, the adjustment is already well underway. So here are the 4 points brought together. The market is already in a real deficit once delivered supply is used instead of nameplate capacity. Most of the world's uranium inventory cannot enter the market, which means the true buffer is much smaller than it looks. That small buffer gives the market only a short runway at current deficit levels. And once that runway ends, the shift from hidden tightness to visible competition happens quickly. And the broader message for investors is that the uranium market doesn't tighten slowly. It tightens quickly, and then all at once. If you want to see how these signals fit together and how we model the timing of the recognition phase, download our white paper, Behind the Curve, Understanding When and How the Uranium Market Turns. It lays out the full framework behind the coming shift from hidden shortage to visible market break.